So far, it's only us, right?
Something doesn't work here, but we are here, which is great.
That's true. Ah, no, wait, they are lining up. Okay. Do we need to let somebody in? No, I think, okay, that's fine. All right, I guess then we kick it off. 4 p.m. local time in Southeast Europe, 3 p.m. local time in Central Europe. Thanks everybody for joining this call about portfolio building and success in startup investments. Broadly speaking, some housekeeping up front. This call is being recorded for the investors who signed up and who might not make it to the call, so that they can benefit from the wisdom of us three as well. I would like to sort of quickly introduce myself for the ones who don't know me yet. I'm Ronald. I'm based in Vienna as the regional manager for the DACH region, Germany, Austria, Switzerland for SeedBlink. And I have two guests here on this podcast, not podcast, webinar, sorry. One is Stefan, who will introduce himself, giving a bit the VC kind of view and investor kind of view. And for all things legal, my colleague Andrei, head of our legal department. Stefan, I will start with you. Maybe you can say a sentence about yourself, please.
One sentence or five?
A few.
A few. Hi, my name is Stefan Köppl. Well, what should I tell about me? I started my career in M&A, somewhat decided that I have to, go the entrepreneurial path, build a company, sold it, went into venture capital. Worked there for 8 years, did deals from pre-seed to, let's say, including Series B, pretty successful. Did quite some exits there, and afterwards decided to co-found Samira Advisors, where we specialize right now on sell-side M&A for small to mid-cap transactions, so everything up to between 10 and 50 million euros transaction volume, mainly in the SaaS marketplace space. And what we do also besides our sell-side mandate is that we consult larger family offices on their M&A, venture capital efforts, venture capital and tech private equity efforts, also when it comes to portfolio construction and similar topics.
All right.
That's about me.
And now we hand over from Vienna to Romania. Andrei.
Hi, everybody, and thanks for joining us today. I'm Andrei Hancu, head of legal of SeedBlink. I am a lawyer, basically. What I do is corporate M&A and capital markets. And for the past 10 years, I've worked with various international law firms, and in the past 4, I've been with SeedBlink, taking care of all the investments we're doing, and now the secondary markets and syndications and all the other products that we're developing. So that's about it.
All right. And after this short introduction, let's cut to the chase. And let's go into winning strategies for startup investors, portfolio building, and key legal clauses. Let me start off by a short introduction, i.e. some misconceptions I often see in the market. And being an investor myself, I think it's important to highlight some things. There's this famous, not necessarily correct statement that 9 out of 10 startups fail. But this is statistically not exactly the case. What is the case, though, is that out of 10 startup investments, there is a chance that 1 or 2 will really succeed and give you quite some financial return. Whereas the other ones might just not basically return money, called walking zombies, or they might go bust and you lose your money. This is essentially what is meant by power laws. Power laws is not something that is only present in the venture capital industry. Power laws can also be basically visible in the public markets. If you look at the companies that are currently driving the Nasdaq, you can boil it down to 7, the fabulous 7 companies. So there's power laws all the way. And this is important to understand. And important to understand in order to pick the winners. And having worked in the old economy, finance and investment banking for over a decade, one of my managers always said, you can't manage return, you can only manage risk. And that, I think, is a healthy way to also look at startup investments. And now, with this rather long monologue, I would like to hear from Stefan, what is his experience as a founder, as an investor, as an M&A advisor? How do you approach startup investments? What's your thesis? How do you manage risk?
Ronald, what you said is pretty fascinating, because I think this tells us in a pretty nice way what often the mistakes of people is, that they want to basically manage the, let's say, the success, but don't manage the risk perfectly. So it's pretty interesting when I talk to fellow investors, but also other VCs. Everyone is telling me basically, you know, the easiest deals are the ones who are succeeding from day one. The interesting question is what you do with all the others. And how do you construct your portfolio in a way so that your risks are equalizing the opportunities basically you have within the portfolio. And I think that's pretty much like it is on the public stock markets. What you need is a certain amount of, let's say, individual deals in order to spread the risk across several, let's say, verticals, across several phases. I mean, it's obvious when we go, let's make the easy case from a late seed, let's say, Series A case, obviously is way less riskier than a pre-seed case. Makes all the sense. Yes, of course, we all agree of that, but of course the opportunity is way lower. I think also, like, say, phase-wise, we should diversify between certain phases we have, and it should be obvious that if I go into pre-seed, that the risk of failure is way, way, way higher than all the others. But let's go to the more interesting topic, to what does it mean for verticals? I think what's the riskiest thing you can do in investing in startups is something called FOMO, and it comes, let's say, it comes in waves, but it comes all the time, and it's pretty interesting to see. And let me give an example. There is we had it basically. It was, funnily enough, an incident. We had this Corona phase, which was basically the end of the low interest area, and what happened was that we had in Europe, all over the place, we had extremely good e-commerce results. And there was a bunch of marketing tech, SaaS companies, somewhat serving this e-commerce market. And of course, they had amazing numbers. And all the VCs and angels, everyone jumped in and said, hey, that's it. I want to be part of this, wave of succeed. Yeah, makes all the sense. I mean, we can now talk about the reasons why it happens. There are many, but this was a wave. There was this FOMO. I want to be part of it. Let's do it. People made 3, 4, 5 investments in the same space. Whatever happens, the e-commerce companies went down, and with them, half of the marketing tech companies, which were related to the topic. Then the interest rate changed, and anyway, there was we all know what happened in the industry then for quite a long time. And I thought people learned quite a bit. But what happened was, there was AI on the table. And it's the same now. Everyone is jumping on the AI topic. And when we talk about managing risks now coming back, I see the next FOMO bubble blowing up somewhat. And I'm wondering if people are now, let's say, if they are intelligent enough to see that if they focus, let's say, a huge part of their portfolio on AI, that they will risk way more than they will be rewarded at the end. So I think, for example, just get back to the point, there are some nice marketing tech opportunities out right now. And instead of focusing purely on AI, you should diversify again and get into other verticals also. That's first intro statement to the topic from my end.
That's an interesting point, and to linger on that AI hype. I mean, that's obviously a controversial topic depending on who you ask, but the fact that I think it was quite recently that Tiger Global will likely buy itself into OpenAI at the 150 billion valuation should at least raise an eyebrow. Let's put it like this. Andrei, what's your take on this? You're on mute, Andrei.
Yeah, sorry. I'm also an investor, both in startup companies and the public market. And I fully agree with the FOMO. I think this is one of the most things that some investors look for. I mean, some of them actually are more interested in what other investors think about the startup instead of focusing on the financials and on what they feel, how they feel about that startup. So this is definitely something that that is taken into account. I don't know if it's good or bad, because sometimes it may be good. I mean, if you go into FOMO and the FOMO is long enough, you have enough time to exit before everything crashes. But maybe you won't have enough time to exit. So I don't think that it's a valid strategy to find and focus on startups that generate fear of missing out. But on the other hand, what I wanted to talk about mainly is that there are cycles. So there are cycles when VC investments are on the wave. It's everybody's riding the wave, everybody's putting money everywhere. And there is, of course, after one of these cycles, there is a down cycle where everybody's more focused on selling what they already have and they're not interested in investing so much. And this, in my personal opinion, equals with opportunity. So I think this is when the best opportunities arise. And what I want to focus especially is on the instruments that are used. I mean, usually when everybody's raising money and the funds have a lot of money to put into companies, usually what happens is that we see a lot of equity rounds. So equity rounds means priced rounds. It's very straightforward. You actually subscribe, buy shares in a company for an amount. But what happens when VCs are not that active, investors are not that active, and companies have a hard time raising money? Because they eventually run out of money. Every company has a runway. When you hit that runway, you need to raise money. It doesn't matter where the market is. If nobody's investing, it doesn't matter because you're gonna die as a company. So then what you do is you raise so-called bridge rounds, meaning that, okay, I still need to hit my KPIs, hit some KPIs in order for a VC fund to invest in me, but I need some money to do that. So what you do is you raise some money usually via a convertible note. Why? Because you don't have a pricing yet, you don't have a valuation of your company because the VC hasn't invested yet, you didn't have an equity round, so you don't know what the valuation is. So what you do is you use a convertible instrument, meaning that you take the money now from investors and you don't issue shares. You basically promise to convert that amount into shares at a future financing round. Of course, this is obviously riskier for investors because nobody, I mean, usually investors, at least retail investors, use VC funds as some kind of I don't know, some kind of stone. If they are investing, then it means that it's okay because somebody's doing the due diligence, and VCs do a lot of due diligence and usually an in-depth one. So this is like a green light. A VC fund is investing in a startup. It means at least that the startup is doing okay. It's fine. So if you invest before an equity round, this means that it's riskier. You don't know if the next round will be a round at a bigger valuation or is going to be a down round. So in order to mitigate this risk, usually you have some incentives like a valuation cap. You say, okay, this will be converted at maximum 20 million euros. It doesn't matter if the round takes place at 100 million. If it takes place at 100 million, going to be converted at the cap, at the 20 million cap. Or you're going to get a discount, usually is alternative, discount or valuation cap, whichever is better for the investor. This means that if the round takes place below the valuation cap, then you're going to get a discount. So it's riskier, but it may be an opportunity to get some shares cheaper than the investors who invest in the equity round. So I think this must be taken into account. And regarding the strategy for how you build your portfolio, I think it's best to use both instruments. I mean, equity rounds when it's time for equity rounds and convertibles when it's time for convertibles. Like in the past 1 year, and Ronald, please tell me if I'm off the mark here, we've had, I think, 90% convertible instruments. Actually, I don't remember the last equity round that we've seen.
Yeah, it's north of 60, I would say. I'm not sure if it's 90. I don't have the figures in front of me. But I mean, yeah, if we recap and sort of linger on what Stefan said, I mean, low interest rates, COVID 2020, then we had the heydays of venture capital and the public markets 2021, 2022. I think Alan Greenspan called this irrational exuberance back in the day. And starting 2023, a normalization back to healthy levels. That's how I would call it, a healthy correction. And this is what we see 2023 and all the way up until today into 2024. And the name of the game is indeed bridge rounds. That doesn't mean that there hasn't been a price round before, but a lot of bridge rounds are done with existing investors and smaller amounts of new investors. And those are obviously often executed via convertible instruments, convertible loan agreements, safes, or ASAs, depending on the jurisdictions. And we see indeed a lot of them. The rationale seems to be, speaking with the various partners in the market, the rationale seems to be bridge yourself into 2025 and basically hope and pray for the best. I'm exaggerating a bit now, but this seems to be the name of the game. And there is indeed reason to believe to be slightly more bullish in the midterm, put it this way. Also assuming that the macroeconomics and the interests are moving in the right direction, that is downwards, and therefore making money cheaper again. Stefan, you raised your hand. I didn't want to
sorry. I just wanted to reply to what you guys just said before, because linking portfolio construction with instruments we have, I think, is something which makes all the sense. Because why? What pretty famous VC from London recently told me, hey, you have to sell when the market goes up, because in the very moment it goes down, it's impossible to sell. Didn't really understand it until I went into, as a VC, this would have been for me, what does he mean? But as an M&A advisor right now, I know exactly what he means with that. And maybe let me give you a brief example. When you have this hype cycle, as you mentioned before, as long as it go up, valuations are going up, everything is good, everything is great. But we have the different verticals. And I mean, of course, there's a general market, which we discussed now. You can't do anything. If it goes down, it's bad luck, yeah? But sorry. But then we have, let's say, different sub-markets, and not all of them are going down at the same time normally. And when you are invested in different sub-markets, even if one or two of them go down, you can maybe sit it out until it goes up again. The problem we have is in the very moment, prices are falling. As you mentioned, we start with bridge rounds. Or what happens in the growth stage is we start with equity rounds with huge liquidation preferences, which is the instrument chosen by growth investors right now to basically do not decrease valuations or hold valuations and still make returns for them. In the very moment this is done, this leads to the fact that as an early stage investor, you can't get out anymore. It's really tricky then to make a good deal for you. So again, this leads us to the fact that as long as you diversify across certain different industry or verticals, there might be a good chance that one of them is going up and you have a good chance to exit at a very fair valuation. And all the others, you can wait until the market conditions change again. This is just something I'm observing on the market, because if you are nervous or if you have to sell in the moment it goes down, there might not be a positive outcome for you.
That's a valid point. I mean, now we touched about looking at it holistically. What we said, we touched upon diversification across vertical/industries, across stages. To some extent, I would argue that also includes geographies and obviously the different means, the different products, be it equity or safes. Maybe taking a step back and going back to how I started with the power laws for an investor, an angel investor interested to build up his own startup portfolio. What's a rule of thumb number of investments that you would need in order to sort of get the alpha into your direction, Stefan? I said 1 to 2 out of 10 might make it. Is 10 enough, or is it likely going to be slightly higher than that?
Depending how certain you are that you make good choices. No, honestly, I would say rule of thumb number is it shouldn't be below 10. It takes you a while until you build it up, because you won't invest in 10 startups at the same time. But I would, as a let's say new angel investor starting to invest, I would tell myself, okay, I choose a ticket size in which I can afford at least 10 investments in order to spread the risk equally. It shouldn't be less than that. if you then see, and I think that's with every, also with a stock portfolio, if you have a, let's say, equally spread portfolio, and then you just want to focus on certain industries because you like them more or less, then you can do it. But I think if you have less than 10, the risk, if you have less than 10 invested in a too little frame of time, then I would say the probability that you have, well, then you are betting. You can have good luck or bad luck, but would be too risky in my opinion. Yeah.
And Andrei, how do you approach your private investment portfolio when it comes to startups?
Again, I fully agree with at least 10. I think I have somewhere around 12 or 13 until now, and I plan to invest a little bit further. And yeah, basically it's I mean, I don't think that you can use the same strategies as in growth companies that are listed companies or public companies. Because in startups, okay, it's true that a lot of them fail and you need to prepare for this, at least mentally, saying that, okay, I have 10 companies. If one of them goes to the moon and the other die, it's okay. I'm going to get a good enough return. Again, I think it's important to diversify over the stages of the company. I mean, as Stefan said, pre-seed, of course, it's a lot of opportunity, but the risk is high. Later stage, like Series A, Series B, or a secondary, even, I don't know, pre-IPO, it's a lot less risky, although not necessarily in pre-IPO stage. I'm not sure what to say about this, but the opportunity is not that big. I mean, I've seen for example, in respect of very late stage companies, I've seen a lot of investors like Series C or D or even later that actually didn't have a return and they had a loss. Because again, according to where the market stands and where the general feel is, sometimes the IPOs happen at a very, very big valuation compared with the, let's say, fair market value of said company. I mean, the classic fair market value, which actually has a financial basis behind it. And sometimes it doesn't happen like that. So it's a little... Anyway, I think it's best to have all the stages of the company from pre-seed to as late as possible, because this again diversifies the risk. So yes, minimum 10 and as much verticals as possible. Of course, provided that you actually like the set vertical, you understand the vertical, and basically you know what you're doing. For example, I don't invest in startups that I don't understand what they're doing, and we had a lot on SeedBlink platform. Like I remember, I don't want to say any names, but they were into Chemtech, and I really don't understand what that even is, not how they do it, what that is. So I tend to stay away from businesses that I don't understand. But I think that a big enough portfolio should be fine in order to minimize the risk.
That's good. I mean, that's the classic rationale. Only put your money into something that you do understand, or at least do understand to a certain extent. Otherwise, it's a bit of, Stefan said, betting beforehand. And I think what I also took away from Stefan's comment beforehand, from quoting the VC in London, don't get too greedy, huh? We see it across the board. And speaking with various VCs almost on a daily basis myself, they will tell you, quite a few of them, that they should have sold stakes in 2021 and 2022 when they haven't done so because it looked awesome on paper. And unfortunately, as it's called in venture capital, a TVPI, meaning profit on paper, is not necessarily correlating with real cash profit. And this is where, unfortunately, a couple of funds are now, and you see some fire sales across the board. So they could have sold not necessarily all their stakes, but smaller stakes. And this is what I find personally is a bit underrated in general. Yes, it is an illiquid asset class. Yes, it's not that easy to get out, but if there's a way to get out at a reasonable multiple, and that doesn't need to be 10 or 100x, why not? Maybe I worked too long in the old finance economy, but if I can double or triple my investment within a year or two via, for instance, the SeedBlink secondary market, I'd be perfectly happy to do so. One more point Yes, please, Mr. Hancu.
About this, I remember that we had a company, again, I'm not going to say any names, we had a company on our platform, which proved to be successful until now. We had a safe investment with a cap, and they raised an equity round at about 5 times that cap. So basically, investors made 5x over that. And I've seen 2 completely different kinds of strategies on the secondary market between the investors. Some of them were doing the double down kind of strategy where, okay, this is successful, I'm gonna put double the money. And they were, even they put the money in the equity round and they bought from the secondary, and they really, really wanted to do the double down kind of strategy. And the others were the opposite. They said like, okay, I've invested 100,000, I'm gonna get my 100,000, I'm gonna sell on the secondary market, and I'm gonna leave the rest to work for me and to assume the risk. So they wanted their money back, and maybe it goes up or it goes down. And I think this is exactly what you said about where is the line between don't get greedy and don't get scared. Because what we know until now, it's okay, they seem to know what they're doing, the company. They raised an equity round at a very great valuation in the shitty market. I mean, this is amazing, just managing to raise money at that kind of valuation. So obviously they're doing something right. Now, I'm asking you guys, what do you see to be the best strategy in this? And how does it correlate with the other startups and the other companies in your portfolio? Because I think that it matters. I mean, if you have 3 successful ones, or you have 10 which are almost dying, and you're kind of clinging on the last hope.
Maybe if I can reply to that, Andrei, because like interesting, my discussion with the London VC didn't end at that point. And we talked about what should be done and what would be the optimal strategy. And basically what he said is like, he also learned from more or less the old economy, from private equity. What he learned is, once you enter an investment, you should set yourself a goal where you exit. And let's say this is I don't know, 10x. Once you have the opportunity at 10x to exit, don't be greedy. Write it down when you enter. If you have the opportunity and it says 10x, you get out. And then you can choose either sell for 10x half of your shares and keep the rest, or sell all of it. But that's the point which you set for yourself, where you said, hey, I will be fine if I have the 10x. Up from now, as Ronald said, I won't be greedy. And I think that this is what you have to do. You just, I mean, it's like with every form of investment, you have to discipline yourself. I think most of the problem, because I mean, greed has to do something with discipline. If you write it down, it's obvious that it's more likely that you will really sell at a certain price if you have the chance to.
Yeah. My view is also a bit driven by my PE/banking background, in a sense that, let me put it this way. There is a reason why in a high-risk asset class like venture, we're always talking about multiples. Now, as a successful VC fund is one that at least at the minimum triples the LP money, the investors' money, over a lifetime of 10 years. Now, if you calculate that on an IRR basis, you will realize you're somewhere in the range of 15 to 20%, maybe 25% IRR, internal rate of return, i.e. annual return, compounded. That's all right-ish, but actually that's not huge for this risk that you take. Now, my view is, I do see the multiple aspect of it. I'd love to report that I had a 10-50x on my investment, but I do focus quite a bit on the IRR aspect. And that's what I said beforehand. If I can invest in a startup and use, for instance, SeedBlink secondary market, and flip my investments within a year and double the money, you know what this means in IRR? That's sky high. And this is how I look at it, to be honest. So do not underestimate the liquidity premium / the time towards exit. It's important. It's not to be underestimated. And I think a couple of VCs made that mistake, quite frankly.
Sure.
Okay, half an hour of trialogue. I think we now open the floor for investors. If anybody has some questions to me, Stefan or Andrei, please. You may use the chat function. You may just use your voice as you see fit. And don't be shy. Not yet. Okay. Then let me add one more point that I wrote down here when Andrei spoke beforehand. The topic of startups always being in need of fundraise. If they don't fundraise or they don't succeed in a funding round, that could be it for them. Talking, being insolvent or running out of money, liquidity. While I think this statement is basically true, what we have also seen over the last 1.5 years, broadly speaking, is I would call a flight to profitability, i.e. investors increasingly push startups to go the path of profitability, i.e. and exactly preparing for tough markets, which we see all over the place. If there is a tough market and you're not able to raise, just make sure the company doesn't go belly up. So we see this, I see this at least for companies of all sizes, that it's not necessarily the classical venture capital game, because the classical game would be hyper growth at all costs. But this mindset changed a bit. And I think I wanted to add this to what Andrei said before. This is what we see increasingly. It's kind of funny if you think about it, because in the traditional way of traditional finance, corporate finance, obviously you look at the bottom line, right? Nobody looked at the bottom line of startups the last couple of years. It was only top line, revenue growth, capture the market. And once the market is captured, flip this whole thing into profitability and we will be out by then long time ago. This has changed quite a bit. So I would argue the venture market in its way of thinking sort of aligned at least a bit with how PEs were always thinking. Would you agree with that? It's trying to make a statement. Let's see whether I get attacked for it.
No, I fully agree with that. Fully agree. And this is, I mean, this is what I currently see on the market. Yeah. I mean, I think the detailed answer is a bit trickier. The problem is what happened is that they, as you said, they flipped from revenue to profitability. Yes, that's true. And I mean, that's a very strong trend we see. The problem we have here is that in a lot of cases, they had very high valuations before. When they flip to profitability, they also flip to EBITDA multiples or similar.
Yes.
And their EBITDA multiples are, of course, not the same. Don't lead to the same results they had when they had, let's say, sales or revenue multiples, which leads to problems in a lot of cases. So I think that that's not an easy situation sometimes. But yeah, the general trend is clear. And I think they became pretty close to each other. And I see a lot, something which I haven't seen, I don't know, 2 years ago, but right now a lot of tech private equity funds are trying to buy venture capital backed companies out from their previous shareholder and that stuff, which is something which is a trend which is increasing right now tremendously.
I just learned from Andrei that please, if you want to ask a question, use the Q&A section and not the chat function. I think the chat is disabled. So if you want to write something down, please use the Q&A down there in the lower bar. Andrei, you want to add something to that? Talking profitability, talking not revenue multiples, talking EBITDA multiples.
Yeah, this is true about the profitability, because it seems that in the last, I don't know, 5, 6, 7 years, because that's how long I've been into this business, everybody was focused purely on growth. They didn't really care about anything else. How much you grow, how much revenue you make, it doesn't matter. I mean, if you grow your revenue 5 times, wow, that's amazing. It doesn't matter if your cost raised 10 times. Nobody actually cared. And it's true that this strategy worked for some companies, Amazon, for example, it worked perfectly. But eventually, and I think nobody should forget this, the sole purpose of a business is to make money. For the founders, for the investors, for everybody who's invested in it. So growth without eventually going profitable is useless. It doesn't matter if you're the biggest company in the world revenue-wise, as long as you're not profitable. And I think that investors are beginning to understand that some companies are prone to growing, but they don't actually know how to be profitable. And that's a whole other skill set for some founders, especially. And that is also true because a lot of investors in the past time, they were only focused on growth. So then you as a founder become only focused on growth. And then you realized, okay, I need to actually make money, make some profit. How do I do that? And it's a whole different set of skills, I think. And now investors and everybody's beginning to realize that yes, growth is important, but it's also important to show that I know how to take care of my money, I know how to minimize the expenses, and I basically know how to make money for my stakeholders.
Yeah, that's a valid point. There's oftentimes a stage of the company where you see leadership changes, in a sense that a founder CEO might not be the best person to flip a company into profitability, because oftentimes this comes along with cuts on resources, and that includes personnel. You need to be a certain type of person to do that, to be willing to do that, quite frankly. So I guess that's an interesting tangent that you brought in here, Andrei. And I mean, it has been the case in the heydays that indeed, also from the investor side, and I know prominent examples without being able to name some, investors told the founders, you need to grow even faster, hypergrowth, name of the game. Put money is cheap, just throw it away and grow top line, because we will never want to see this company profitable. We want to see this company sold at the highest potential multiple, which is a top line multiple, a revenue multiple. And somebody else should take care and basically form this into a profitable company. So quite frankly, there is a couple of PE funds out there and strategic player whose core business exactly this is. And that's why you oftentimes don't hear of even famous startups. You don't hear that much about them anymore once they get integrated into a corporate or bought up by some PE, because what these guys are doing, they are slashing down and turning it into a profitable entity, or either inside a corporate or as a standalone entity. Would you agree with that from an M&A viewpoint, Stefan?
Yeah, absolutely. Well, I mean, I just wanted to add something before, because like you mentioned the topic of growing at all costs. There are some pretty interesting examples, and one of them I met recently is the interesting case. They raised the Series A pretty big, and the investor said, you know what, you have to grow at all costs, just throw away the money. The problem was that they had an extremely high churn rate of their clients. And of course, with, if you just insert some coins on SCA or whatever, LinkedIn and so on, you can basically buy clients. I mean, they are non-profitable clients. So with every euro you spend, you get, let's say, 60 cents back. Doesn't make sense at all. But from an investor perspective, this was, hey, cool. It's like we're growing top line. And we will take care of the churn later on. In my opinion, the problem is or was that they were scaling a problem. So they had a small problem. They could have solved it without injecting a huge chunk of money. But no, they scaled the problem even with money. And once you've got a certain user base, it's even worse. And I think it's what we see right now is that a lot of, let's say, PE funds and so on, they are buying brands of these products. I mean, the branding is pretty nice, because if they were used by a lot of clients, of course, depending, because like if the product was not the best one, it might not make sense to buy the company right now. But if the product was okay-ish, and VCs put in a lot of money, it's normally a nice brand out there, and as a corporate, you can use this brand further on and grow it internally with corporate structures, which then makes sense, yeah, if you can buy it cheap.
I see one of our investors raised the hand, Horia Zamfir. So please, I think we unmuted you. You may ask your question, Horia. Where is he?
Sorry, by mistake, sorry.
Oh, that was by mistake.
It was by mistake, he said.
Okay. All right, got it. So then, yeah, I mean, it's interesting, I believe, to follow even once the companies were sold, were exited, what happened to them. I mean, especially if you work in the financial industry, I mean, banks and big asset managers, they bought quite a few of startup scale-ups in the past, and then at least for me, They were pretty much gone from the market. You didn't really see them anymore. You might have seen their product still, but they always got integrated in such a way that they're just not their standalone entities anymore. And then what happens quite often as well, once the founders are sort of off the hook and let go because of their earn-out phases, they oftentimes just move on and do something else, right?
Of course. But I think it's like in a lot of cases, the transaction rationale for this kind of acquisition was simply to buy cheap customers, which would be extremely expensive to acquire for yourself.
Yeah.
And I mean, this is what quite a lot of fintechs manage pretty well, that they found channels how to acquire, let's say, comparably cheap clients. And then the big financial institutions just, took over all the clients, migrated them on their own products, and the old brand or product disappears pretty quickly. Yeah.
And I mean, it's also like, if you're going down the route of building up such a knowledge-based company, like say Google's DeepMind AI did, I mean, then you're literally getting acquired because of your talent. I mean, we see this now currently in the AI space. It used to be acqui-hires quite a bit, but they got expensive, let's be frank. And what you now see increasingly is the big tech companies doing acqui-hires, but not buying the corporate entities, but buying the people out and paying them well. I mean, Microsoft and Apple and the likes have done this recently quite a bit. It's interesting to see.
Well, it is what they call a reverse acqui-hire. We also see this, and it doesn't make our lives better, to be honest. But this happens in the AI space. That's common right now. So basically, they check who is worth it, and then they make good offers to them and don't acquire the company.
Yeah.
It happens, yeah.
I see an investor question here that says, as an investor in startups, I often see companies failing to achieve their over-ambitious targets. What to do then? When is it the correct time to forget about the money invested and dump the shares? That's a good one.
Who is replying to that? Is it me?
Whoever wants. I can start if you want.
Please, you start.
Personally speaking, forget about the money and dump the shares is probably not a wise strategy if the company is doing really bad. I mean, the bet here would be, I've seen successful companies who were close to insolvency more than once and to pivot it into something successful. Now, this is the hope dies last kind of mentality. But sort of dumping the shares at what is called a falling knife, a startup that is really doing bad, is probably not gonna be very satisfactory or successful to you. So I guess my personal opinion is not an assessment. My personal opinion would be keep them. In a worst case scenario, you lose the money, but if you get back 10 cents on the dollar, that's also close to zero. So rather hope for the best, and maybe there's a turnaround on the horizon.
I fully agree with you, Ronald. I would maybe specify it a little bit. I think it depends why they are not reaching their goals. I mean, there are these kind of founders, I know them pretty well, who set themselves extremely high goals every year and they never achieve them, but they're still doing well. So I would say then it's okay-ish. And other than that, it depends how you can trust them. I mean, if you still trust the product they have, if you still trust the founder, but they have, for example, just a sales problem, which can be solved by whatever kind of, product pivot and sell it differently, then I think you can keep it. And as you said, Roland, it's like once it really goes down, it doesn't make sense to sell anyway, because you might get 10 cents on a dollar. So, well, it's gone anyway. So you can keep it and hope for whatever lucky shot with an M&A, for example.
Yeah, exactly.
I fully agree with what you said, and normally, yeah, it's never a good idea to sell. I mean, why do it? But in the specific context of SeedBlink investments, there are also some costs associated. So especially for the investors who invested via the SPVs, they need to pour some money into the SPVs so the companies continue to exist and they pay their fees and the headquarters and whatever they need to pay. So there is a point when you need to decide, especially for companies who are obviously dead. I mean, the founders are long gone, there are no assets, nobody's taking care of it, but sometimes it happens that they don't get the work done until the end, like closing the company, and it remains in some kind of a limbo. And then as an investor, you need to decide, okay, is it worth it to support the costs of keeping the SPV alive? Or should I say, okay, that it is what it is, put option, sell everything for $1, and at least I'm not spending any more money. So this is really, really specific for how investments through our platform work, because they entail some costs. And I don't think that it makes sense anymore. And I'm having in my mind some clear examples of companies who have zero chances of doing anything because nobody cares anymore. They're long gone, they're doing something else, they have jobs, they...
Okay,
no,
but then it's an obvious decision.
Yeah. Yeah, exactly. I mean, if it's free, if it doesn't cost you anything, yeah, don't sell. Why sell?
Exactly.
But if it is a cost for you, then maybe decide to say, okay, it is what it is, sell it.
That's a very valid addition. Thanks for that, Andrei. Any further questions from the audience? You can still use the Q&A function if you want. Doesn't seem so. If that is the case, then I guess we can wrap it up here. I guess that was educational for me. Always learning something, speaking with people who see it from different angles. So very helpful for me, hope also for the audience. I'd like to say thanks Stefan for his time, Andrei for his time, and all the investors who joined in, and see you at the next SeedBlink webinar. Have a good one. Ciao, ciao.
Thank you very much for the invitation. Bye-bye.
Thank you, everybody. Thanks, Ronald.